Welcome back, viewers. This is CPH Oscar, and today we are going to resume our series on economic environment, and we are going to look at the international trade, and we are going to look at it in a sense of how important is it to call out international trade. What are some of the theories that are within the international trade, and we look at the terms of trade, balance of payment, and we look at some of the restrictions, and finally we look at the economic integration, and that's how it's going to be. So we can kick off without wasting more time. Let's first understand what is international trade. International trade is the exchange of goods or commodities across the national borders of the country. It is the exchange of goods or commodities across the national borders of the country, or it is the exchange of commodities between residents of one country and those of the other country. But this one is a very easy one, and it will not be hard for you to grasp. It is the exchange of commodities across the national borders of the country. International trade is either visible or invisible. This exchange of commodities, these commodities may be services, may be goods, and we are talking about these items we are exchanging as in terms of being visible or invisible. And visible trade is the exchange of goods between countries, and the invisible one is the exchange of services. These services, we can talk about them in terms of, let's say, tourism. You can talk about tourism and others. Then foreign trade or international trade is divided into two forms. We have the bilateral trade and the multilateral trade. Here, when we talk about international trade, we say that it is the exchange of goods across countries or boundaries of the country. It means we are either going to be engaging in goods or we are going to be engaging in services. And if we are engaging in services, then it brings us to, are we going to be doing that trade within two countries, or we are going to be doing the trade among different countries? And that's the multi. Bilateral, bi means two. Lateral trade means we are going to be doing the trade within two people or engaging two countries. Then multilateral is where we are trading with so many countries. Then we have a note here, and the note says that if a country sells commodities to other countries, then those are called exports. If you are moving the goods from your country to other country, that's export. And the activity is called export trade. When you're moving items from your country to other countries, that is export trade. And what are we giving out to other countries? They are called exports. And vice versa. For the country that buys commodities from other country, they are called imports. What we are buying, and the activity is called import trade. That's how we can summarize the international trade, and we'll be able to look at it in a broad view, because we've seen the visible trade, invisible, bilateral, export, and import trade. All of that comes from the word. Whenever you get involved in international trade, what we get to know is that are you exporting goods, or you are doing services? Are you the one exporting, or you are just receiving the goods? If at all that one is known, are you doing it with only one company, or country, or you are doing it with so many countries. This is multi. This is supposed to be hyphen. Okay, hope we are at par now. Let's go to some of the reasons why are we carrying out international trade. Why do we call out international trade, or why do countries call out international trade? Reasons for international trade. One is the difference in the natural resource endowment. Difference in the natural resource endowment, what we mean is that different countries have different assets and resources, like in terms of minerals, forests, golds, and others. So we come together so that we can be able to specialize that since we have different resources, we are going to be making different items. And for those countries that don't have those resources that are in a different country, can be able to concentrate on producing what they can produce best, so that they can get what they can't produce. If at all they can produce certain items, but they can produce those items at a very high cost, then it means that we are supposed to engage in international trade so that we'll be able to get those items at a very less cost than us producing it by ourselves. And when we do that, then we are going to be importing those goods into our country, the ones which we can't produce at a lower cost. Then we also give out, as in terms of exporting goods that we can produce at a very less costs. That's what we can talk about the difference in the natural resource endowment. And this, when you look at it, you make sure that you summarize by saying that countries with the different resources, they need to specialize in whatever they can produce at a very less cost, and they import what they can't produce at a less cost. That's all about the difference in natural resource endowment. The other one is this lack of self-reliance or self-sufficiency in terms of goods and services. There is no country that can provide whatever it needs. So if at all that cannot be done, then it means that we are supposed to get some goods that we cannot produce, and we make sure we can be able to receive those goods that we cannot get out of our resources or our available resources. Here we are saying that no country can satisfy all their needs, so countries come together to get what they can't produce locally. The third one is need to dispose of the surplus production. When you have the first point, we said we have the resources, but those resources we can use them to produce more goods. But those goods we are going to produce, it's not a must that we are going to consume all of it. Part of it will be there, and when it is left, instead of wasting it, so we can engage in international trade so that we can give out to those countries that have a scarcity, or that cannot produce those items that we have in plenty. When we do that, we are trying to dispose of the surplus production. Then the fourth one, we can talk about the need for specialization. The need for specialization in the production and exportation of commodities. Here we are looking at we need the specialization because we have different resources and we can produce certain items at a very less cost. So it means if we specialize in the production of those commodities that we can produce at a very least cost, then it means we are going to be able to get a lot of items or output, and we'll be able to engage with others that have what we can't produce. That's what we call by need for specialization. Then the other one is a need for foreign exchange. Of course, you can't import, or you can't deal, even if you don't want to go into international trade, but you can't give out items or selling items to people with different currencies. If at all you don't engage in international trade, you will not be able to get these foreign currency that you are going to use when you're selling commodities within a country. So we need international trade to get the foreign exchange, and that foreign exchange is the one we are going to use for when we are doing the imports or when you are importing from foreign countries. The other one is difference in taste and preference among the citizens of different countries. You find that people have different tastes on items that are produced within the country and those that are produced outside the country. You find that people may prefer to import certain items than consuming what they are receiving or what are produced locally. So you find that people go into international trade just because different people have different tastes on certain products, or they have different desires on the products that are produced between countries. Then the second last, we can talk about the need to import the modern technologies. What happens is that some countries have the resources, but they lack the capacity to exploit those resources. So what they do, they engage into international trade so that they can be able to import those resources that they can use to exploit the natural resources that they have. They can be in form of the machines, in form of getting skilled personnel, getting capital and all of that. So there is a need for international trade in order to get the modern technology that can be used to exploit the available resources. Then the last one, we can talk about the need to promote international relationship. When you have, if let's say your neighbors in neighboring countries, you have to promote peace and unity. What you do, the only way that can unite you is when you're doing trade, when you're transacting together and you have some common items, as we are going to see when we go to economic integration. We shall be seeing how we come together and we enjoy the trade creation and all of that. So there is that international relationship that we need to maintain. That's why we go into international trade. So we can proceed to the next one and we try to look at the theories, some of the theories that are within the international trade or which facilitates international trade. One of them is, these are principles or theories of international trade. One of them is the theory of absolute advantage. This was proposed by Adam Smith. And this theory states that given two countries producing two commodities using similar resources, given two countries producing two commodities using similar resources, a country should specialize in production of a commodity where it can produce more units at a less cost than the other. For it, it only looks at the cost we are going to be incurring must be the same. The cost is supposed to be less than the other country. Then the resources are supposed to be the same. Then we are supposed to be engaged in two products, and it considers the economy that has, so the world that has two countries. So what this theory is assuming, those are the ones that it assumes. Two countries producing two commodities using similar resources. Then they are saying, if it is so, then we expect that a country should specialize in production of that commodity where it can produce more units than the other at a lesser cost. It can produce more units than the other. If you try to look at an example here, we have countries, we have Kenya and Uganda. We have tons of cotton that are produced by different countries, the tons of coffee that are produced by different countries. We have Kenya is producing 4,000 tons of cotton and 16,000 tons of coffee. Then Uganda produces 10,000 tons of cotton and 20,000 tons of coffee. So what do this theory assumes? It says that these, so long as they are using the same resources and they are producing two items and they are two countries, we expect that one should specialize in production of that item where it can produce more units than the other at a lesser cost. Remember, they are using the same resources. So Kenya used the same resources to produce cotton. But instead of producing more than what Uganda produced, for them they produced 4,000, but Uganda produced 10,000. Remember, they are using similar resources. And using the same resources, similar resources, Uganda was able to produce 20,000 tons of coffee and Kenya produced only 16,000 of coffee. So what this theory suggests is that we go with the country that can produce more units at a lesser cost because the cost is constant. So from the above table, Uganda has absolute advantage in production of both commodities. Why? Because it produces 10,000, which is more than 4,000 of Kenya, and 20,000, which is more than the 16,000 of Kenya. So here they are saying that Uganda has a comparative advantage in production of both commodities. This is because given the same amount of resources, Uganda is able to produce more units of cotton and coffee than Kenya. And you've seen Uganda is producing 10,000 and 20,000, which is higher compared to the output that is produced by Kenya. So that's how it suggests. But there are some weaknesses into this theory, whereby, because now for it says, now it's like assuming that Kenya will not produce anything, since it cannot produce higher. So by understanding the weaknesses that were brought by the absolute advantage, then we introduced another theory, that is the theory of comparative advantage. And this is our second theory. That is the principle of comparative advantage. And for this system, or for this theory, for it says that given two countries, we are still on two countries, they are producing two commodities and they are using similar resources. But for it says a country should be specialized in production of a commodity where it incurs the least opportunity cost than the other. Here they are talking about the opportunity cost. And you know from the beginning that opportunity cost is alternative foregone when choice has been made. You make a choice, you leave one. If let's say you have to produce cotton and coffee, you find that which one can give you a more profit and you leave the other. So by leaving the other, it's like the opportunity cost, the production of that item you have selected is as a result of dropping the other one. So that's what we mean. And we are saying that according to this theory, a country is said to have a comparative advantage if it can produce more commodities. Sorry, if it can produce a commodity at a lower opportunity cost than the other, irrespective of the absolute advantage. And for that reason, we said it is irrespective of the absolute advantage. The person may be having an absolute advantage over the other in production of both commodities. But for it looks at the opportunity cost, the alternative foregone when you made a choice to produce a certain item. So we use the same example. And the reason why I use the same example is that I want you to get a difference. You get a difference from this and from what we've discussed earlier. And we say the opportunity cost is got by alternative foregone over actual output. So we proceed. We have the countries, they are the same, but now we are computing opportunity cost for production of cotton. Opportunity cost for producing cotton, this cotton. If Uganda, if let's say Kenya wants to produce cotton, we are looking at the opportunity cost of producing cotton. So it means, if you are going to be following this, it means that if Kenya wants to produce cotton, it has to forego this. If you want to produce 4,000 tons of cotton, you have to forego these 6,000 tons of coffee. And we try to get this. The alternative foregone is this, is the 16,000 divided by the actual production. We produced this, we foregone the 16,000 tons of coffee and we produced 4,000 tons of cotton. It will be this divided by this. So when you get 16,000 divided by 4,000, you will be getting 4. And these are 4 tons of cotton that are produced after foregoing this. Then for Uganda, if it wants to produce cotton, it has to forego 20,000 tons of coffee. So it will be the alternative foregone, which is 20,000 divided by 10,000, which is 2. So now we try to look at the decision, the opportunity cost for producing coffee. This means that Uganda should specialize in production of cotton since it has a lower opportunity cost of 2 tons of coffee than Kenya, which has 4 tons of coffee. This 4 you are seeing, it is 4 tons of coffee that we foregone in order to produce this. Then what this theory assumes is that we take the item that has a least opportunity cost, and this one has a lower, which is 2. So it means that Uganda should specialize in production of cotton and forego coffee. Why? Because it has a least opportunity cost than Kenya, irrespective of the comparative advantage. Because for it, for the absolute advantage, for it, it was suggesting that this one is supposed to produce the 2 items. But for the comparative advantage, we are saying no, we are looking at the least, the one which has the lowest opportunity cost. So let's look at the opportunity cost for production of coffee. And we are saying that if we are to produce coffee, Kenya will forego 4,000 tons of cotton in order to produce 16,000 tons of coffee. So it means the alternative foregone will be this 4 divided by 16, and we shall be getting 0.25. 0.25, that's a quarter ton. It's a quarter a ton. That's 1 over 4 tons that are supposed to be foregone. So if we look at Uganda to produce coffee, it has to forego 1,000 tons of cotton. So if you get the alternative foregone, which is 1,000 divided by the 20,000, you will get 0.5. That is a half a ton. So you now compare from this one, which one is the smallest. Then from here, we get the conclusion and we say opportunity cost for producing coffee is that Kenya should specialize in production of coffee because it incurs the lowest opportunity cost of 0.25 tons of coffee, of cotton, than Uganda, which foregoes 0.5 tons of cotton. Hence, Kenya has a comparative advantage in the production of coffee than Uganda. Hope you can be able to understand that. And if the video has been helpful, please make sure you subscribe and you share so that also others can have a benefit and we'll be able to learn more and more. Thank you and God bless you.